The world of finance is facing a silent, seismic shift. While most eyes are on the AI boom, a hidden structural fracture is growing within the massive $3 trillion private credit market. This is Default by Innovation. We're exploring how the very technology driving the next industrial revolution is simultaneously hollowing out the collateral that underpins billions in debt. Let's dive into the upcoming dislocation of 2026. The core of the problem lies in a fundamental duration mismatch. Historically, private lenders backed, quote, hard assets like real estate or aircraft, assets with linear, predictable lives and stable secondary markets. But today, tech collateral like SaaS IP and GPUs make up 25% of direct lending. Unlike a building, this tech has a non-linear depreciation curve. In 18 to 36 months, legacy silicon doesn't just lose value. It becomes digital lettuce, rotting instantly as it's surpassed by newer, faster innovations. The moats we thought were permanent are being vaporized by zero marginal cost AI code generation. We've reached a dangerous tipping point. Between 2015 and 2025, private equity financed nearly 2,000 software LBOs, pushing debt to EBITDA ratios to a fragile 6 to 7 times. What was supposed to be safe, senior secured debt has effectively transformed into high-risk venture capital exposure. Why? Because the moat of high coding barriers is collapsing. With Agentic AI, even non-technical users can bypass vendor lock-in. As AI agents replace human workers, the traditional, quote, per-seat subscription model is structurally falling apart, taking projected revenues down with it. How does default by innovation actually play out? It starts with the deployment of autonomous coding frameworks. As replication costs drop towards zero, per-seat pricing evaporates, and customer counts plummet. This causes ARR to decouple from the high enterprise valuations used to underwrite these loans. To delay the inevitable, companies spike their payment in kind or PIK utilization. But soon, debt exceeds enterprise value. With terminal liquidation value at zero, lenders are left unsecured. UBS Global Research warns this could drive default rates to an unprecedented 15%. Capital has pivoted aggressively toward asset-based finance to build the AI infrastructure. Look at the CoreWeave archetype, a $14 billion debt stack built on top of NVIDIA GPU hardware. Lenders are treating these GPU clusters like stable infrastructure, projecting $40 billion in data center ABS issuance by 2026. But there's a brutal reality being ignored: the semiconductor architectural cycle. Treating a rapidly depreciating chip like a long-term building is a recipe for a mispricing disaster. Hyperscaler accounting fictions are obscuring a brutal non-linear depreciation cliff. On the books, value looks like a steady downward slope. In the secondary market, it's a series of violent drops. Look at the silicon obsolescence scorecard. The A100 from 2020 is already fully obsolete. The H100, which costs $35,000, has plummeted 85% in secondary value to just $6,000. With the Blackwell and Rubin architectures promising 45 to over 600 times the inference speed, operating obsolete hardware becomes an economic impossibility. It's not just about speed, it's about power. By the end of 2026, the demand to run 12.5 million Blackwell GPUs will reach 25 gigawatts. However, only 17 gigawatts of fresh data center capacity is coming online. This 8 gigawatt structural deficit forces a migration event. Operators must physically gut legacy H100 centers to free up power for Blackwell racks. A GPU without electricity has zero economic utility. This drops the residual value of H100 collateral to near zero, long before the 5-year loans ever mature. The entire GPU-backed credit market is a highly leveraged bet on foundational model burn rates. It's a delicate circle. NVIDIA sells the hardware, neoclouds use private credit to buy it, and users like OpenAI burn billions in compute, requiring constant venture injections. But the existential threat is vertical integration. As hyperscalers develop custom silicon like Maya or TPU to break NVIDIA's pricing power, the revenue covenants for borrowers will breach. If the venture capital money slows down, lenders will be left holding billions in stranded, debt-encumbered hardware. Systemic distress is being systematically hidden. On the surface, public default rates look low at 1.9%. But beneath the waterline, the reality is chilling. Borrowers are increasingly using PIK, paying debt with more debt, to stay afloat. Shadow defaults, where companies defer interest, now stand at over 6%. We even see huge discrepancies in valuations. In recent restructurings, different lenders marked the exact same loan with a 14-cent gap. The transparency is gone. We are heading toward an illiquidity trap. A $162 billion maturity wall hits in 2026. Refinancing these 2021 vintage loans is mathematically impossible at today's doubled interest rates. At the same time, retail investors are waking up. Semi-liquid business development companies, or BDCs, are seeing massive redemption requests. Blackstone's BCRED and Blue Owl are already facing billions in outflows and forced asset liquidations. The quote, liquidity illusion of the last decade is finally fracturing.
Surviving this hardware finance crisis requires a total change in strategy. First, move from monthly reports to API-integrated daily telemetry, cryptographically verifying that the hardware is actually powered on and generating revenue. Second, implement dynamic margin calls linked to real-time secondary market pricing. Finally, the most radical step, embedded kill switches. Lenders must have the technical capability to remotely disable hardware and initiate liquidation waterfalls the moment a covenant is breached, before the next architectural generation renders the assets worthless. The 2026 dislocation will be a period of extreme risk and extreme opportunity. Winning institutions will surgically re-underwrite their portfolios, divesting from legacy SaaS while accumulating moats in proprietary data and regulated systems. They will reject linear depreciation models and stress test against custom silicon. Further prepared, this is a chance to act as a liquidity provider, acquiring top-tier assets at deep discounts as others panic. Generating alpha in this decade requires navigating the extinction of the SaaS moat and the silicon depreciation death spiral. Are you ready?